Hey everyone, it's Jen. You know, not too long ago, the Blast Foundation and Arcade Research actually reached out to me to help Pacman share the story and vision behind Blast. And with all of the exciting announcements around the Blast ecosystem and phase 2 now starting, I kind of figured the best place to start would be by interviewing Pacman himself, the CEO of Arcade Research and a core contributor to the Blast Foundation. So with that said, let's dig in. Pacman, first and foremost, congratulations to Arcade Research and the Blast Foundation on phase 2. I was actually wondering, could you tell us about the difference between Arcade Research and the Blast Foundation, because this was an announcement that just came out and I think a lot of folks are a little curious.
To give you a quick mental model, it's kind of like the difference between the Ethereum Foundation and Consensus. So the Blast Foundation, they shared the Blast vision. They're kind of like the high-level stewards of the ecosystem, allocating incentives and the like. And then Arcade Research, our role and incentive here is to basically develop infrastructure to support the Blast ecosystem. So it's very similar to the Ethereum Foundation Consensus model.
Yeah, that makes a whole lot of sense. I would love to zoom out and get a little bit of context around your background specifically for those who may have not heard or don't know.
Let me keep this short just because I don't know how many people are new to this or how many already know, but basically I got my start in Silicon Valley around 10 years ago. Basically when I was 16, I moved from Boston to San Francisco and started working as a software engineer. I basically got an internship and then turned that into a full-time job, and I ended up quitting high school in order to do that. And after doing that for about a year, I started my first company and went through Y Combinator when I was 17. Ran that for about a year and then finally went to MIT. Kind of had a weird path, but I ended up actually going to college at the right age of 18. Went to MIT and studied math with computer science for about 2 years, and then realized I wanted to start another company. I ended up getting the Teal Fellowship to start my first business, which was Namebase. It was also a crypto company, so it was on a niche blockchain called Handshake, and we ran that business, my co-founder and I. We ran it for about 3 years, and we sold it at the end of 2021 to Namecheap, which is the second largest domain registrar in the world. They're the biggest competitor to GoDaddy.
Yeah.
And then basically immediately after Namecheap, during that year in 2021, I got personally really into NFTs. Fell in love with trading, and then most people now know me from what my co-founder and I did next, which was Blur. So we started Blur as an NFT marketplace for pro traders, and we're the core contributors behind it. We bootstrapped that from zero to the largest NFT marketplace globally. And in the process of running and contributing to Blur, we basically realized at a certain point that there was no L2 that really seemed exciting to us and was fitting our needs. And so my co-founder and I, again, we started up a new project, which is Blast. And now my co-founder and I are basically both contributing to Blur and Blast, and very involved in both ecosystems.
So when Blast was first announced back in November of last year, it was fudded for so many different reasons, which to me is now hilarious to look back, right, retrospectively. And here we are about 3 months later, and I believe Blast is not only one of the fastest growing L2s right now, but it's actually the 6th largest chain. Was this something that the folks either at Arcade Research or even at the Blast Foundation were anticipating?
Yeah, so we didn't have a specific goal in mind. It wasn't oh, within 4 months, this is going to become 6th largest chain globally. But directionally, we knew that Blast would resonate. And the reason why is because my co-founder, Anthony, and I, we didn't want to start an L2. The reason why we went down that motion is because in the process of contributing to Blur, we started, and just building in the space in general, we looked at all the different L2s, we dived into them from a technical perspective, we spoke with their teams, and what we found was that none of the L2s were really building or providing anything that resonated with us as builders of one of the largest apps on Ethereum. And from there, we then kind of organically just conceptualized a chain that actually would excite us as builders. And that was a chain that actually had yield that allowed us to basically have a new building block to build something effectively new that you couldn't do anywhere else. And then from from that conception, we knew that, just because we had that firsthand experience of, building a dApp on Ethereum, we knew that it would also resonate with other builders and community members. So it's like, while we didn't have a specific goal, the outcome here of it resonating and, achieving traction, that was directionally what we expected.
So I've noticed that there's this emphasis on being a full stack chain versus L2. How are you viewing chains versus L2s to begin with?
When you think about the distinction, it's really, a good mental model is, you don't think of Facebook as, the social network written in PHP. You don't think of Instagram as, the photo sharing site written in Python. It's an implementation detail at the end of the day. And an L2, is effectively an implementation detail. What we've noticed is that for the Blast users in the Blast community, the emphasis is really, what does the chain enable for them? What is the value? And they're not thinking, oh, what like L1 or L2 do I want to use? They're more so thinking, oh, do I want to bring my, time, attention, liquidity to Blast, or do I want to bring it to Solana or some other ecosystem?
Like, it does not matter.
It does not matter what the implementation detail is.
Yeah.
And, for Blast, at the end of the day, the current implementation detail is as an L2. There's a world where that even changes if it actually benefits the user and if there's value in doing so. But really the focus is, this is an on-chain economy that's being provided to the community. There's an opportunity to create the #1 on-chain economy through building out the full stack chain. But the real, unique value prop is that this is a high yield on-chain economy that is enabling new experiences that you can't get anywhere else.
When we talk about on-chain economies today, can we dig into a little bit of like why you think this is important and where it's going long term?
I think the answer to that really depends on what timeline you're thinking about when you say long term. But in the limit, what do you get when you're on-chain? You get global liquidity, you get the permissionless ability to spend and transact and invest your liquidity, whenever and wherever you want. You get the ability to align incentives with token creation that is just not possible outside of the on-chain economy. And what those primitives enable is really it enables the most market efficient structure for a financial economy of any sort. And so if you think about, okay, what happens when everyone is on chain, what gets unlocked there, it's actually very, very different than what is unlocked right now. If you look at the current structure of the market, if you want to save money, you have to have a bank account and maybe like a savings account, right? With a certain amount of yield, it's probably not that good. If you want to invest
0.3%.
0.3%, right? And they're using that that liquidity for their own purposes. If you want to spend money, maybe you're using PayPal or Stripe. If you want to send it cross-border, there's probably significant fees involved in that. There's significant frictions, right? It takes days for things to transfer and settle, and as a business, it takes much longer. It takes like 2 months basically, for like the chargeback period. So if you look at that existing structure, there's a lot of inefficiencies that if you sum it all up, it's trillions of dollars of value leakage out of the system. And what is the system? It's people transacting with their own finances, right? Like all of the value of the financial economy is from individuals who have their own liquidity, using and spending that liquidity. So all of this, trillions of dollars of value, it's literally from the community, effectively.
Yeah.
And if that entire community is on chain, what do you need? You don't need PayPal anymore. You don't need your savings account anymore. You don't need Visa, MasterCard, any of these things.
All of the middlemen that are always taking the fees.
Right, and then right now in the current system, they are needed, right? But on chain, that's not needed. And that's just the base level primitives, right? There's everything that you build on top of that. There's all the businesses on top of that that also get significantly disrupted. And the value of that market structure basically shifts from this existing system, which is basically leeching value away from the community, and it goes back to the community because you get rid of all those intermediaries. So I think in the limit, you basically are able to enable more wealth creation. It's honestly not even creation, it's more so retaining wealth for the system back to the community in a way that's just not possible in the current system. So I think that outcome is incredibly profound, and when we are there, what effectively happens is it's not the system where you basically bank the unbanked for people who are like not currently in the financial system. Actually, what ends up happening is you unbank the banked. You unbank the people who are currently in the financial system, and they basically don't need to participate in that system anymore because they can basically keep their entire finances on chain. And if you look at actually the deepest like crypto natives today, they're kind of like 90% of the way there. They already spend 90% of their time on chain, and they actually have 90% plus of their liquidity and wealth on chain. So people are like, basically if you look at the natives of any ecosystem, it kind of gives you a sense of what the future holds as that ecosystem spreads. That's the outcome that's going to be accomplished as the on-chain economy grows, and it's the Blast Foundation's view to basically accelerate that as quickly as possible.
So like Blast Foundation, ultimate goal as we think about on-chain economies is really to unbank the banked. Fair to say?
Yeah, I think that's fair to say. That's the higher mission. Of course, it's a long road to get there, and the first step in getting there is building out the full stack chain.
Well, let's double tap on the full stack chain, because I think a lot of folks at home might be like, well, what does that mean? Like, how does that actually play out? And so, like, let's double click on that. How does the full stack chain actually enable new on-chain experiences?
In order to understand, have a good mental model for it, it's really important to first take a look at the existing on-chain ecosystem. So if you look at every chain today, whether it's Solana, Ethereum, Mainnet, BSC, like any chain, there's a very similar end-to-end user experience. You go from your bank to your SEX to your desktop wallet, maybe you throw in a mobile wallet and TGBot, and then after all of these layers, you finally get onto the chain, and then you finally get onto the dApp. That entire funnel is extremely inefficient. You have different fragmented pieces of infrastructure. They don't necessarily communicate or coordinate well with each other, and it creates a end-to-end user experience that's very, very wrought with just friction, and basically you lose conversion the entire step of the way.
Well, it makes so much sense that you're saying that, because I remember when I first came into crypto, like the only way in the US to on-ramp is like through an exchange, and then God forbid you send to like the wrong network.
Yeah.
Like you just lose that money, and that's wild to me.
Yeah, and this experience, this existing fragmented ecosystem, if you study the transitions of various technologies in the past, if you look specifically at mobile, there's a lot of parallels. So the closest parallel here is Android, where if you look at what Android does, they build the operating system, which is kind of, you can model it as like the chain, right, of the mobile economy. And they rely on third-party devices like Samsung, Huawei, et cetera, to build that end user experience. And that approach works, but it has a flaw in that it doesn't have this integrated experience that is actually very important in terms of creating the most powerful mobile capabilities that can basically just like unlock incredible value for the economy. There's that Android approach, which is basically what every chain today does. They just focus on the chain itself, and they rely on the third parties to fill in the rest. And then there's the opposite approach, which is the Apple approach. And the Apple approach is, what do? They don't just build iOS. They build iOS, and they build the iPhone, the hardware. They build the software to integrate the software, the OS and the hardware. A great mental model here is, imagine AirPods if AirPods didn't just magically sync with your iPhone the first time you opened it.
It'd be like the boys' headphones, or like
right, exactly.
Bluetooth.
Yeah, you have to download an app, and then you have to
Yeah.
enable Bluetooth, and then the Bluetooth barely works, and then it's just like that. If you think about that system, the outcome of that product experience would be entirely different if it was built with this Android approach. But because it was integrated and cohesive, it actually enabled a completely different outcome. So the mental model for the full stack chain is, instead of just focusing on just the chain itself, if this entire ecosystem focuses on optimizing the end-to-end user experience, you can actually not only just make it more seamless, but you can enable entirely new metas to be built around it.
Mm-hmm. I want to dig into like the Apple Android comparison. I love that you use that, because like makes sense to me. But when I think about Apple, it's like you said, they build out everything. Is the Blast Foundation like planning on actually building out the apps as well, or is it more just focused on the infrastructure to enable other builders to come and build on top?
Yeah, so the foundation, and they lay this out in their vision, which is, I recommend everyone check it out. It's blast.io/vision. Basically what the foundation is doing is coordinating the community to build out this full stack. So, the foundation has the power of the incentives and the coordination as, the official, foundation for the ecosystem to help assist with this coordination. And so it's not that the foundation itself is building the apps or anything like that, but it's more so coordinating the ecosystem to actually build out this full stack. And then, of course, for us at Arcade Research as a Blast development company, we're very aligned with that, and we're going to be working on building out different pieces of the stack to basically support that vision with the rest of the community.
So how is Arcade Research contributing to this bigger vision?
Yeah, so we're really focused on the pieces of infrastructure that the users of today, the on-chain users broadly, basically rely on the most. And that really starts with the wallets. When we think through the wallet experience today for crypto natives, it's just very clear to us that there's a lot of low-hanging fruit to make that entire experience not just more seamless, but also more powerful. And I don't really want to get into specifics just for competitive reasons, but to give you a mental model on this, you can imagine the iPhone. If the iPhone didn't have the hardware capabilities like accelerometer, GPS, Face ID,
things like
Bluetooth,
Uber literally would not exist.
Exactly,
Yeah,
exactly.
yeah, yeah.
So, at the end of the day, the software only has as many capabilities as the hardware enables, and you need that integration. And right now, we kind of see this on-chain infrastructure as effectively in a state that's kind of similar to this pre-iPhone era. And there's a lot of low-hanging fruit that we see that can basically just take the entire space up a level.
So when talking about the app, it's very clear to me how that helps the user experience, but how does this help the developer experience?
For developers, the most important thing is the set of building blocks that they have available to them. If you're a Web 2 builder, the thing that's most important is what APIs are available to you. And as soon as we started having APIs for payments, APIs for sending text messages, APIs for connecting to your bank account, it was only after all of those building blocks came together that we saw really incredible applications being built. At the same time, for on-chain developers, the building blocks, APIs that they have available to them are limited today compared to what they could be. And so once there are all these building blocks, then it basically just opens up the design space for what's possible in a way that's very difficult to predict, but is intuitively very powerful if you are a developer.
Outside of what Arcade Research is doing, is there anything in particular that you would be excited to see get built on Blast?
And I think the thing that I'm most excited about is, at the end of the day, Blast is an ecosystem, and it's only driven forward by not just the users and the developers building on to it. And there's two angles to this. One is the building blocks, and then two is also the community, because it is an ecosystem. So on the building blocks side, right now, as it is today, the main new building blocks are the native yield and the gas fee sharing. So of course, we all know about native yield. Gas fee sharing is a little bit less known, but basically, Blast is quite unlike other chains in that all of the gas fee revenue, instead of it being held by the foundation, it basically gets redirected back to the developers programmatically. And so now if you're an app that drives a lot of transactions, you can actually keep that revenue for yourself, and it's an entirely new revenue stream. And these two primitives were, and the other thing just to note is that the adoption cycle for new building blocks for developers is very, very long, right? Users can just switch over to and try out a new dApp immediately, right? But for an application, if you want to build something that's legit, it's going to take at least a team of people 3 to 6 months to go and build. So any of these new primitives, if you think about, first you need to get developers coming onto the chain, and then they need to wrap their heads around it, and they need to build with it, that adoption cycle is a lot longer than you would normally see for a user cycle. So the fact that there's even things that are already starting to take advantage of that on Blast within a 4-month period is incredible. Two of the applications that have really taken advantage of this is one, IKB. So IKB is, you can think of it as a competitor to DraftKings and FanDuel, and these are both of them each are $20 billion sports betting apps. and they have a rake of around 10 to 15%, I believe. And if you look at what IKB's done, they actually have a very disruptive business model. They charge a 0% rake. It's kind of similar to like Robinhood coming out with the first trading product that charged 0 commission on trading. And the way that they're able to do that is because they have native yield as a new revenue stream that they're able to tap into, and they can basically set that rate to 0 and give that to the users. So that's a really cool business model. The other really cool business model that you're familiar with is Blaster, where they have these refundable NFT mints. Instead of just spending the money to mint an NFT, you can basically just lock up your capital. The yield from that capital is used to actually mint the NFT, and you can kind of think of it as like a no-loss mint, and it's dubbed as like a refundable NFT. And again, like this is just like a new business model that's just enabled through the native yield. And the fact that those two things came out so quickly is really, that was surprising to me, just how quickly it happened. But beyond that, what do we get when the developer is able to take advantage of new building blocks? That's something that's going to be really, really incredible to see, but we're still in the very early stages of that.
New metas?
New metas. At the end of the day, it's all about enabling new metas. That's what these building blocks do. If you don't have new metas, then at the end of the day, you have very limited ability to actually create something that is fresh for the market. And then the other side of this, which is actually, it's kind of an unintuitive building block, but Blast is very unique as a chain in that it has a highly concentrated set of crypto native users and builders. And that alone is actually a building block that can enable new metas. I think a great example of this is if you look at the success of Fantasy. It's a fantasy sports game for crypto Twitter. And that's something that really can only take off if you have both the crypto native users and the crypto native builders building for them. So when you think about an ecosystem, the things that are possible in the ecosystem is not just dependent on like the API technological primitives, but it's also very dependent on the social layer. And for Blast, the Blast social layer is a very crypto native social layer, and that alone actually enables entirely new experiences. Now you layer that on with the new technological primitives, and it's quite a powerful ecosystem.
Okay, you brought this up. You brought up Fantasy. Do you know what I'm going to ask? I need to ask about your tweet schedule. And you opened this door because you brought up Fantasy.
Yes.
Is it intentional? Are you intentionally not tweeting during tournaments?
Not intentionally tweeting, but if you buy a builder's card close to TGE, that's really like an at your own risk move right there. I can't really comment on that.
Fine, fair enough, fair enough. I actually want to get your perspective on how you felt the incentive design for phase 1 went. I think one of the unique features about Blast and how the foundation chose to go about distributing incentives directly back to the builders is one of the things that makes this whole thing stand out. Did you feel like the way incentives were designed for phase 1 was effective? Like what worked and what didn't work?
So of course this is something that I've had a lot of experience with, and the foundation has learned a lot from, and I get to experience this myself and also advise the foundation on. And when I think about what happened during phase 1, I would say overall it was absolutely a success. Like if you just look at the deliverables, 6th largest on-chain economy, not just by TVL, but even DEX volume. It's 5th largest by fees paid. The user growth and transaction growth has just been insane. 200 plus dApps have launched during this period. All of those outcomes have been incredible. With that said, at the same time, there was a lot of inefficiencies along the way, and just in terms of how the gold was distributed, how the system was set up, teams learning how to interact with them, and teams learning like the best way to use them. There was a lot that went right, but there's also just like a lot that could have done better. So I know that this is something that the foundation is taking into account and learning for phase 2. I'm actually just really excited for that because it's like phase 1 already worked incredibly well. If you solve some of the core issues, and they are solvable issues, with the phase 1 incentives and apply them to phase 2, I think that the outcome can be really, really incredible. So I'm just excited to see that.
I think that all sounds great. But when we talk about incentives, I think there is a lot of skepticism around, are incentives sustainable? And so when you take that and you view it through the lens of Blast, like how are you as an individual thinking about it? How is Arcade Research thinking about it?
Yeah, absolutely. This is, it's so funny. It's something that I've heard, basically for like the past 2 years straight. And it's something that I see a lot of people get wrong. And the biggest misconception about incentives is a lot of people think, oh, incentives just create, inorganic, unsustainable activity. That's not actually correct. What incentives do is they're incredibly powerful. They can mask a lack of product market fit, but that's only if the incentives are driving people into something that doesn't have retention. If you drive people into something that does have retention, then the incentives will work just fine because you take away the incentives and the network is still there. If you drive people to something that no one will ever want to use, even if they're not getting paid to do it, then absolutely you will never have product market fit. And as soon as you take the incentives away, you will have this outcome where basically the ecosystem disappears.
But I think the pushback that you're going to get on that is, can we really say that the activity on Blast is organic activity, considering how heavily incentivized users are, how heavily incentivized developers are?
Yeah, so it's not a question of is it organic activity. It's more of a question of what is the behavior of the system once you gradually start reducing the incentives and even set them to zero. And the behavior of the system, in order to understand that, you have to think through what are the things that Blast actually incentivize. So if you're really paying attention, what you'll notice is that Blast really focus on incentivizing dApps that already had retention and product market fit, even prior to Blast existing, right? So these are things like DEXs, these are like lending protocols, perp DEXs. These are all things that crypto natives already do on-chain a lot of, like a lot of. So that mental model gave the, basically using that mental model, you can have a lot of conviction that if you bring this crypto native set of users that are already doing these behaviors over to this new ecosystem and give them those same primitives, if not more powerful ones powered by the yield, you actually will have retention. And I think the easiest way to model this is, and see if this is working or not, is you have to look at the Blast activity over time throughout phase one. So the Blast incentives were constant throughout all of phase one. But the activity, if you look at the charts, started off very low, right? Like it had a spike on day one and then it basically fell and then it slowly climbed back up. Same thing with the transaction fees, same thing with the users over time. So all of those core usage metrics actually grew over time, even though the incentives stayed constant throughout. And the reason why that happened was because it took some time for the dApps to basically hit traction, for them to get good enough. As more and more dApps launched, Fantasy and all these other ones, we started seeing increasingly more levels of feedback where people were basically saying like, oh, everyone was saying Blast was a dead chain at launch, but now 2 months later, and actually there's more things to do on Blast than any other chain that I've experienced. And that outcome was very deliberate. I think stepping back a bit, if you study the history of incentives, it's very clear that incentives are incredibly powerful and can be effective if used right. So a chain is effectively, you can think of it as a crypto native city of sorts. And if you study the development of cities and countries in the past, the best example is actually America. The American Homestead Act of 1862 actually incentivized the development of the American West. Basically, it gave you like a plot of land if you cultivated a plot of land, and that act was basically a driving force for the entire development of the West. And then, of course, now we know that the American West has incredible retention, and the byproduct of that is Silicon Valley and this entire development. It's quite significant. Even a recent example, if you look at Dubai, right? Like they create a city in the middle of the desert. How do they do that? It's really through the power of incentives. And we all know through all the crypto natives that live there that they created something that was retentive. So at the end of the day, incentives can work, but the issue and the reason why they get a bad rep is because they're very often applied improperly in order to mask product market fit. And it's very, very hard to tell when they're going on, whether the product market fit is there or not, unless you have a really good mental model of the actual behavior of the users. If you do have a good mental model of the behavior of the users, then you can start assessing, along with some other metrics, like we have with like the activities growing over time and the users growing over time, then you start to be able to basically discern whether they're working effectively or not.
I don't think it's a secret that we can really contribute the incentive meta that we're seeing to Blur. And one of the common through lines that I've noticed is actually any time that you have had a hand in designing an incentive system, it has been so explicitly different and against the norm of what we have historically seen in crypto and Web3. Why do you think that is?
Yeah, when we think about incentives and look at incentives, the way that they're often applied, typically in the form of a retroactive airdrop, is effectively a form of marketing, which is fine. You know, incentives are a great way to
Short-term, though.
market. That is very short term. But the real power of incentives is not marketing. The real power of incentives and the real utility of it is in coordination. And what you're doing through incentives is coordinating a network of participants into actions that basically create a positive systemic outcome. And if you study the history of incentives in the crypto space, you know, it started first with Bitcoin. Bitcoin laid out the groundwork for incentives, and it's very explicit. If you provide this much hashing power, you will earn this much Bitcoin. And it's static. And it was an incredible incentive system, right? It incentivized the adoption of an entire, you know, new trillion-dollar industry from scratch in 10 years time period, which is crazy. But that was a very specific goal that Bitcoin had. As the crypto industry has grown, the scope of the goals has also grown. So if you look at the next step of incentives, what was that? That was effectively liquidity mining, where we started seeing DeFi protocols, you know, around 2020 start to lay out, you know, explicit token emission designs to incentivize behavior that was positive for those protocols. Those protocols were still fairly basic protocols, but you know, that was basically the next evolution. The issue with that is that those static incentives don't necessarily allow you to account for dynamic market behavior. And so sometimes those incentives could get exploited really easily, or maybe the market conditions and requirements change, and once they were set, you can't change them anymore. And so it's really good for coordinating at the very beginning, but it basically breaks down very quickly. So what we did to take it to the next level was we created the concept of seasons, where instead of having a static incentive system, you basically have a, you know, semi-static incentive system for the scope of one season. And throughout that system, you're able to adjust to market behaviors that develop that are emergent, that you didn't expect. And then once the season ends, you can, you know, basically assess, you know, where the system is and then adjust from there.
Basically what the Blast Foundation is doing with phase 2.
Exactly. And if you think about what is the Blast ecosystem trying to accomplish, it's effectively building out a new city from scratch. And the incentives are there to support the network of participants to basically coordinate them into developing that new city. And it's been, you know, very effective in this past 4 months, and it will continue to be, you know, iterated on and developed. I still think there's like a lot of low-hanging fruit that's there actually to basically do a better job of coordination. But really what's happening is it's not the Blast Foundation or myself or the other contributors that are actually making this happen at the end of the day. It's the network of the builders and the users that are coordinating themselves into creating this new city. And basically the incentives are there to just support that coordination.
Yeah, it's, I think something that that like really stuck in my mind from the last time we spoke about this was like, how can we design a system to numerically, to the best of anyone's ability, right, accurately reward someone for their individual contributions to the growth of the ecosystem?
Yeah, absolutely. And if you are one of the, you know, founding fathers or mothers or theys of this new city, you basically get to participate in the upside of that city. So it's, you know, that's really what all of this incentives is about. It's really a matter of coordination.
I want to build on top of the city analogy. I think like one of the fascinating things is like if we think of Blast as a city, it's like a concentrated population of crypto natives, i.e. degens. Yet there's this broader mission of like unbanking the banked. So how are we going from a city full of like crypto degens to that consumer moment for Onchain? Like how do you see that playing out?
So every technology has to go through multiple phases of adoption in order to spread. The first phase of adoption is reaching the early believers and adopters. The next phase is reaching the early majority, and then the late majority, and then the laggards. These are people who won't use something unless they're forced to use it.
The boomers.
Right, exactly
Yeah.
right. And going from the early adopters to the early majority, that's really the hardest step. That's known as crossing the chasm. For a network technology where, and that's what, you know, blockchains are, where the value of the technology grows as more and more people are using it, going after the early majority before you've built up a network of early adopters is a recipe for failure.
Yeah.
This is why you see a lot of attempts from either new chains or projects that, you know, say from the beginning, hey, we're going to go and onboard the masses. This is why that motion never works. It's a recipe for failure. This is why for Blast, for ecosystem development, Blast hyper-focused on onboarding the early adopters first, because that served as building up a beachhead network that basically allows you to start to accrue enough value in the network to go after the next stage, which is crossing the chasm to reach the early majority.
That all sounds great, but I think with this broader vision of like unbanking the bank, like that is like, to me, a retail vision. So I totally get like there is a need to focus on improving the experience for crypto natives who are here now, but at what point are we ready for that like big on-chain consumer moment?
If you think about a network technology, typically the way that adoption happens is you have some existing infrastructure that is good enough for that early believer network.
Yeah.
And then once you have that network, the infrastructure develops enough and the network grows enough such that it's actually valuable enough for that next wave. eBay is a great example of this, where the first wave of people were people who just traded like antiques and little widgets and collectibles, very, very niche. And then as the platform grew and the infrastructure grew, then it started taking on more and more. And now it's like you can use eBay to buy like literally anything. Right now it's going after the masses. Zoom back, this is really an on-chain city. If you think about even just like America's development, the first adopters were the pilgrims who came for religious freedom, right? That was like the unique value of America, was religious freedom. But then as America started getting developed and the infrastructure developed and the opportunities developed, now America started transitioning to the land of opportunity. And now the American dream. And then that onboards, first the unique selling point is the religious freedom, and then as the network grows, the next unique selling point is the American dream that onboards the next wave, and that's how you snowball the network effect. So for Blast, the first selling point was the native yield for the crypto natives. Now that the network is there, the next phase of that is building out the infrastructure to create the full stack chain. And that is laying the foundation to basically, after the full stack chain, now you go after the early majority as the next stage of adoption. But it's only in that stepwise, yeah, you have to go 1, 2, 3. Yeah. A lot of projects, they basically just try to skip directly to step 3 before they do step 2.
And step 2 is like the hardest step to do.
Yeah.
So that's probably why.
Exactly.
I think, so taking that and like just zooming out, what is the end state of all of this? Like what does this look like in the next 10 to 20 years?
Yeah, the end state of this, if you think about Blast today, for the most native user, you have a chain where by default your assets are earning yield, right? If you have your ETH, you're earning 3 to 4% yield just by doing nothing.
8 to 10.
Yeah, USDB 8 to 10. That as a default is already a significant value prop. And then what can you do? Well, of course, there's all the opportunities and the different tools and the dApps that exist on chain. Even just in USDB alone, you have this stable store of value that's giving you yield that you can send anywhere around the world 24/7 for less than a cent. These value props are actually value props that are, you can imagine how useful it is for the entire broader
Well, it's practical.
market. It's very, very practical. And at the end of the day, humans are extremely practical beings. They will only use something if it's providing them value. So when you think through what is the long-term end goal and what is the end state, well, once you have everyone on the system, they really don't need to use that previous system, right? It's like I mentioned at the beginning, you don't need the PayPal, you don't need the bank, you don't need the Visa, the MasterCard. You can do everything on chain, and all those opportunities exist on chain. And what you're able to do is you're basically able to live your entire financial life on chain, and you effectively unbank yourself. And so this is why the 10-year end game vision for Blast is to unbank the banked.
I think what you said is just so interesting, because I do think that a lot of people have onboarded into crypto because there is like this financial incentive. And it goes back to what you said earlier, like humans are just very, very practical. And when I think about what is happening in crypto and how you guys are building, it feels like not only is this a parallel financial system, but it's actual freedom and freedom to transact.
Yeah, the thing that I think gets missed the most is a lot of people see the degen activity and that turns them off from the space, and it kind of distracts from what the actual end game is. It's perfectly okay for the users to come on for that financial opportunity, right? To come to America for the land, for the land of opportunity. But what gets you to stay is once you're here, you have a better life. Once you're on chain, you do have a better life. You have the higher yield, you have the freedom to transact, you have all these opportunities
You're
that exist.
actually getting value returned to you and
You're
not
getting
extracted
exactly.
from you.
So at the end of the day, these, the current degenning, that is really just a bootstrapping mechanism. And it's a bootstrapping mechanism that's a means to an end. The end game is you effectively have this completely unbanked network of individuals that can transact on this permissionless network that is just bringing those networked individuals significantly more value than that previous system. And just in order to get there, you have to go through that bootstrapping phase.
I love that. And I actually think that's kind of almost the perfect note to end on. But before we end, do you have any closing thoughts? Is there anything else you wanted to share?
Yeah, I think it's very important for the community to understand where value comes from. If you think about Bitcoin, the value that is unlocked through Bitcoin, it's not creating value out of thin air. It's effectively unlocking value that was latent in the market. There is inherent value to a digital gold being created that is 100x easier to store, verify, transact with. That, as a competitor to physical gold, is just inherently valuable. Similarly, for the on-chain economy, and even just if you look at Blast in phase 1 alone, what did Blast in phase 1 do? Well, there was already a lot of value latent in the ecosystem in terms of all of the users and liquidity on existing L2s where they weren't earning yield. And what Blast did is it created a market structure that unlocked that latent value by giving the users that came onto it that yield to them by default.
So phase 2 is really about empowering the users and developers to tap into this value.
Exactly. Even the on-chain economy today is still incredibly inefficient, and there is a significant amount of value that can be unlocked once the users and the developers coordinate to go ahead and unlock that value. And that is what phase 2 is all about, is supporting the users and developers to coordinate to unlock that native value.
I love that. I mean, I thought I was excited about phase 2 before, but man, after this, that was great. Well, Pacman, as always, thank you for having me. It was such a pleasure to talk to you, and thank you for sharing your thoughts and giving this perspective, because I actually think it's really helpful for folks that are new to crypto and Web3 to kind of understand like the fundamental thought process behind why is Blast so different.
Yeah, absolutely. Thanks for coming here, Jen.